Who knows when the next inflation bomb will go off, or if it ever will in your lifetime. But you don't have to let this very real risk paralyze you and keep you from entering and enjoying your hard-earned retirement. In this video, I share with you 2 ways you can hedge this significant risk. Welcome back. For those of you who don't know me, my name is Stephen Spicer. I'm a certified financial planner, and I have helped hundreds of clients with this problem. In fact, this is one of the first things that I'm talking about with clients. I talk about risks once we decide to work together. Before we go into all the fun planning details and we look at the different vehicles that you can use to accomplish your various goals, I want to talk about the risks to which you're exposed. It's important that you understand all the things that we're trying to combat, all the things that could derail your life goals. And I frequently, when watching videos online of other advisors and the planning that they're doing for clients, I frequently see them shrugging off some of these risks, actually a lot of these risks. And I want to make sure that you're aware of them. That's part of why I wrote my book, Stop Investing Like They Tell You, because I kept seeing some of these problems repeatedly crop up. I talked to clients and they would tell me this is the first time that they had ever heard about this from any other advisor. And so I want to make sure that you're aware of some of the risks. I mean, that's talking about the risks of stock and bond only portfolios, but today I want to talk about the risk of inflation and potentially having higher inflation in the future. I'm not saying that it's definitely going to happen. I'm not trying to fearmonger or scaremonger. I just want you to be aware of the risks of what's possible and what happens if you have significant inflation, higher inflation than we have had historically, which is absolutely a possibility. So let's jump behind the screen real quick and look at some of the planning software that I often see advisors use. And they'll frequently get to a screen like this, which I love to spend time here because this correlates directly with many of the risks that we're talking about. But I want to make sure that we're stress testing your plan for various risks that might come up in the future. And a lot of times when I see advisors get to this point, this is about as far as they want to push the idea of inflation. If inflation is 1% higher than what they're expecting, than what this is modeling, then there's an 80% chance of success for this particular plan. The baseline here is 93% for this particular client. So it drops 13 percentage points, just from the average inflation going forward being 1% higher on average over the course of time. Now, this is assuming a 2.5% inflation, so 3.5% is not crazy, especially when you understand how inflation actually works versus CPI, the Consumer Price Index, which I explain in detail in this video. Anyway, once you understand that, you'll realize that a 3.5% inflation ongoing is not a crazy expectation. So you should ask your advisor what expectation they're planning for, what they're projecting out, because it makes a big difference. 1 percentage point this way or that way is going to have a significant impact on the future of your portfolio. Most of your investments are not going to be able to keep up with a prolonged elevated inflation, especially not a hyperinflation, which I can't really illustrate in this software. So your advisor isn't really able to illustrate that for you properly in this software, where you have a maybe shorter period of significantly higher inflation than we're going to be able to look at here. But this software is going to look at over a long period of time. So over your retirement, what if it was at 3% instead of 1%, 3% higher than that 2.5% we're looking at? So a prolonged 5.5% inflation level. Well, it's going to drop your probability of success from that 93% baseline all the way down to a 31%, 32% chance of success, which obviously is unacceptable if you're right now trying to decide whether or not you want to enter retirement. This is part of the reason I think that people spend very little of their retirement savings, because they don't know what the future might hold. They don't know if the stock and bond only portfolio is going to hold up in the same way that it has over the past, because the past doesn't necessarily guarantee the future. They don't know if there's going to be some period of higher inflation, because we've been living through some pretty high inflation recently, even though the government tries to tell us that everything's fine. There are risks that we know that we have deep down that a lot of advisors don't want to talk about. This is one of them. And this is a significant difference in what is being projected just by this extra 3% on average per year. I know that's a lot. It's probably not going to happen. But if it does, you have a 31%, 32% chance of success, chance of not running out of money in retirement. Is that acceptable to you? And are you prepared for that? And what if it's worse? Like I said, we can't test every scenario here, but the max that we can pump this up to is a 5% inflation rate. If we do that, if we increase this to 7.5%, which would be the overall, you're running out of money on most of your scenarios pretty early on. 4.4% of them won't run out of money. And of course, we have a lot of variables going on here. If we increase your longevity as well, then you're potentially going to run out of money even sooner. Longevity is another big risk that people have in mind. Another big reason that people don't spin down their portfolios, because they see their friends or they see their parents living longer and needing their money to last longer. And it's a stressful situation. So you need to be prepared for all of these different things that might come up. And I know it's impossible to be totally prepared and protected against everything, but it's not ridiculous to be insulated against this risk. The solutions here are not fun to talk about. I hate having this conversation because I feel more like a doomsayer. I feel a little bit more uncomfortable about this, but I try to think through, if there was this period of hyperinflation, where is the money going to go? Where has the money gone historically in societies and countries and economies where there was hyperinflation? Well, a lot of times it goes to physical goods, and that's fine. That's something that you could stock up on. That's what Mark Cuban talks about, buying in bulk, and that's a way to help insulate against future inflation. But what kind of assets would benefit from a hyperinflation type scenario? Well, initially, as there's higher than normal inflation, people don't like having money in banks, and so they tend to move it into stocks. They see stocks going up, and so more and more money flows into stocks. But if it's prolonged, if there's a prolonged period of hyperinflation, people are tightening their belts. They're spending less on average than they had been in the past. So less money is going to the grocery store. Less money is going to all goods, everything. They're trying to spend less. They're forced to spend less. Their money isn't going quite as far. And then from a business perspective, business expenses are getting higher. It costs more to fuel their machinery. It costs more to keep their business going. And so as expenses go up for businesses and revenues go down because people are spending less, eventually those earning calls stop looking very good, and people start to see that. And so that money flowing into the stock market only lasts so long. Eventually, give it 6 months, a year, this inflationary environment would catch up to the earnings, and those aren't going to look as attractive anymore from an investment perspective. So then where does the money go? A lot of times you hear people talk about it flowing into gold. So let's look at how gold has actually performed when the stock market is down. This is not necessarily in a hyperinflationary environment, but gold tends to be a safe haven asset when inflation is taking place. And so let's look at what happens to gold when the stock market's down. Let's look at the last 50 years. Let's take every 5-year period, and let's look at every single week looking back 5 years. So this week, let's look back 5 years. Where was the stock market? Where is it at the end of this week? And then let's go back last week, 5 years before that. And we're going to do that over the last 50 years to see how the S&P 500 has performed and how gold has performed in relation to the S&P 500. Well, 2,130 of those weeks, the S&P 500 was up. In 1,341 of those, gold also rose. So 63% of the time that the S&P 500 was up, gold was up. Now, the S&P 500 over that same 50-year period, over each of those 5-year intervals, was down 549 times. 549 of those weeks. You could look back 5 years and the S&P 500 was down from where it was 5 years prior. Only in 11 of those did gold also fail to be up. There was one prolonged fail in the 1990s when European central banks dumped a bunch of gold because it was panicking. Aside from that one, if you take that one out, on a weekly basis, over any 5-year period, gold has been up when US stocks are down 98% of the time. Now, there's no guarantee of what's going to happen in the future, but historically, gold has tended to be a good hedge when stocks are coming down. And also, it's a good hedge when inflation is taking off. So even if stocks are down for non-inflationary reasons, gold tends to be a good hedge for that as well. And just real quick, I mean, you can get your gold however you want if that's something you want to do. Call me old-fashioned, but I prefer it to be physical. I like it discreetly delivered to my house. Some good old-fashioned gold coins. It's silly, but like Scrooge McDuck, I like my gold to be here, tangible. I can touch it. I know it's here. And then as there's chaos in the world, I have something, somewhat of a chaos hedge, a wealth preservation play, if you will. Now, the second asset class that some of my clients will look toward as a inflation hedge is a bit more speculative. I don't recommend it for everybody, and I usually recommend it as a smaller percentage of their overarching chaos hedge. So a combination of gold plus Bitcoin. If you think about where the money would flow today, if we ran into hyperinflation right now, where would smart money go, or where would big money go as they're panicking and everything is going crazy, stocks are starting to fall because inflation's catching up to them? Where does the money flow? Some of it would go to gold, sure, and other metals. But today, I believe it would flow to cryptocurrencies and Bitcoin with the longest track record. And this isn't to say anything about what the future might hold for it. It's just that if right now there was a hyperinflationary situation, I absolutely can see more and more money flowing into an asset like that. So it's a wealth preservation play. It's a hyperinflation insurance. It's a chaos hedge. Those are all different terms that you can use for it. But in my mind, when we're talking to clients, for myself as well, for my mom, we're taking 8 to 12% of your portfolio, and it really depends on where you're at. The amount that you put here really depends on your situation. Obviously, if you're really far away from retirement, you have 10 plus years, then maybe it doesn't matter quite as much. You have time to recover if there is some chaotic situation. But if you're getting close to retirement and you're trying to make these plans, this can throw everything off, especially once you enter retirement. If, especially early on, you run into this hyperinflationary type environment, then it can devastate your plans. And so having this hedge can help insulate you from that. As I said, the amount that you put in there is going to vary based on your situation, but usually it's somewhere between 8 to 12% of your portfolio. And it's set up as a kind of set it and forget it type situation. I have my physical gold, I put it away, and I'm not looking at it as an investment, as an asset that I'm monitoring on a quarterly basis and how it's performing and adjusting based on its performance. I don't really care necessarily how it's performing from one quarter to the next, from 1 year to the next. What's important to me is knowing that it's there because it's this chaos hedge, it's this inflation hedge. I'm probably not going to need it. I hope I don't need it because that would imply a kind of chaotic scenario in the world that most people probably aren't prepared for. But if I do need it, I have comfort that it's there. It provides me with a peace of mind because I know that this is a very real risk. Even if it's a small one, I know it's a very real risk that's out there. The 60-40 stock and bond, any combination of the stock and bond portfolio falls short of this. It does nothing to help you here in this hyperinflationary environment. Both of those stocks, bonds would fall short. And this is just one of several risks that you're exposed to, several of which many advisors just ignore because, like this, they're difficult and not fun to deal with. I break down, I think there's 9 of them in this video right here. See you there.